Hello, everybody, and welcome into Commodity Culture, where our goal is to make you a better investor in the commodities sector. My name is Jesse Day. Today is April 23rd, 2026, and before we dive in, standard disclaimer, nothing here is investment advice. Do your own due diligence. My guest today is a director at Fusion Fuels, an energy group and integrated energy platform delivering today's essential fuel and utilities while shaping the clean energy solutions of tomorrow. It's Paul Backwell. Great to have you on the show.
Thanks very much for having us, Jesse. Really appreciate it.
Energy certainly is a timely topic, and I'd love to get your current assessment of energy markets worldwide and the challenges they're facing as the war in the Middle East and the on-again, off-again closure of the Strait of Hormuz threaten supply chains.
Yeah, good question to kick off, Jesse. So I would say that the energy market is at a real genuine inflection point. I think that's clear to everyone. That instability in the Middle East is really just accelerating trends that I think were already well underway from what I've seen. And after Ukraine, more than 30 countries overhauled their energy policies to prioritize their domestic supply. And now, with these Red Sea shipping attacks, the tensions in the Gulf, the Straits of Hormuz threats, as you've alluded to, roughly 20% of the world's oil and a huge chunk of LNG transits are going through that strait, right? So that vulnerability of single source, single route supply chains has never really been more exposed than today. So we believe global energy investments are increasing even further from an astonishing $3 trillion in 2024, $3 trillion in 2024. That was the largest annual figure ever recorded. And it was driven precisely by that fear, right? That single source supply fear. So governments simply aren't willing to rely on one supplier or one corridor anymore. Energy securities, it's really become national security. And with the IEA projecting over 30% demand growth by 2040, with everything that's going on in the world, the rise of AI data centers, etc., meeting that demand while at the same time hedging that geopolitical risk I'd say it's defining the challenge of our generation. Yes, I'm in the industry, so I probably would say that, but certainly, I mean, we're feeling it at the pumps. At the fuel pumps, it's affecting our daily lives, right?
Absolutely. And one conclusion, of course, that could be drawn from the issues we're facing due to this conflict is that the world needs both a more diversified mix of energy production geographically, as you alluded to, and of course, of different energy sources. What are some potential solutions to ensure that we don't leave ourselves so vulnerable in the future?
Yeah, I mean, it's not even debatable anymore. It's really the consensus of government, of national bodies, of many investors, even that single source reliance is over. And I think the playbook that we're following today almost rhymes closely to that of the 1970s in response to the Arab oil embargo, if you recall. Back then, nations built their strategic reserves. Nuclear capacity grew around that time as a result, around 15 times actually between 1970 and 1985. And then, if you recall as well, the companies built to serve that diversification became the energy majors, I guess, as we can call them, the ones that we know today, the likes of Exxon, Shell, Total, I guess maybe to name a few of them. But I think we found ourselves now in a parallel moment, right? The solutions fall into a few clear buckets. Nuclear, 30 plus nations have pledged to triple their capacity by 2050. There's already 75 plus reactors, I think, under construction. So there's a lot of investment going into, for example, domestic gas infrastructure too, because last mile distribution has become actually a strategic asset. And then also green hydrogen, though it's not a perfect solution, but it can be produced wherever you've got renewables and water, so you can produce it domestically. So that's important to countries and governments. And then, of course, uranium supply, supply chain security of uranium. Western utilities, as we've seen, are urgently trying to source non-Russian supply following the sanctions. So the key insight, really, I would say, is that no single technology wins. Demand keeps growing. The transition is going to be messy, but we believe that the smart money backs platforms that span multiple fuel types across multiple geographies.
Well, let's talk about synthetic fuels, green hydrogen, biofuels, because these are technologies that have been around for a while, but are starting to come into focus for investors, political leaders, and policymakers. Fusion fuel is involved in both green hydrogen and biomass thermal power generation. Can you walk us through those technologies and why they're so promising?
Yeah, good question. I mentioned green hydrogen isn't perfect, but I'll sort of explain it, and I'm sure many of your listeners will know. But it's produced through electrolysis, so that's renewable electricity splitting water into hydrogen and oxygen, and there's zero carbon emissions in that process. The appeal really is that it can replace fossil fuels in industrial processes, in heavy transport, in power generation. And because the inputs are just water and renewable electricity, you can produce it anywhere, right? It's more important in the EU where they've put serious regulatory weight behind it. And there's lots of tariffs and things like that. So there's lots of binding mandates, and that's really what's driving the demand for green hydrogen across Europe, and particularly where we operate across Southern Europe. So with that in mind, Bright Hydrogen Solutions is our hydrogen subsidiary. It's an end-to-end platform. We operate across Iberia, so across Southern Europe primarily, although also into the rest of Europe. We deliver advisory services through EPC and operations. We've got a 57 megawatt active pipeline, a 15 megawatt front end design contracts in hand, and then a 30 million euro infrastructure investment vehicle that structures each plant on a project finance basis, is the simplest way I can put it. So it's non-dilutive to the parent company, to Fusion. The first project, a Spanish cement facility, is actually going into build out now. So that's the hydrogen side. And, you know, then on the biomass thermal side, it's a different, but I would say equally compelling story on a smaller scale at the moment, but we're certainly growing it. So our BioSteam Energy joint venture in South Africa replaces coal-fired industrial boilers with systems fueled by waste biomass. So that waste biomass is agricultural waste, it's forestry residue, wood pellets, and the likes. High calorific value pellets that go into a burner system and create steam energy. It's a compact technology, it's water resistant, it's zero additives, and we're actually deploying our first project at Fairfield Dairies. So that's one of the South Africa's, I'd say it's one of the leading dairy processors in South Africa, certainly a household name in South Africa. I'm from South Africa. I grew up drinking Fairfield milk. Um, but the point is, if I'll just explain the situation in South Africa, right? You've got, for what it's worth, um, you've got a government electricity, national electricity provider, which is effectively dysfunctional, right? Then you've got a number of these large industrial facilities, factories that are running 24/7, Coca-Cola factories and the likes, right? Large industrial plants. Solar power doesn't cut it, doesn't provide reliable or enough power, and then neither does wind, right? So you're forced to look for a solution because Eskom, the government provider, doesn't have enough coal in the country. It's not able to produce enough electricity. You've got constant electricity cuts, and it's just you're forced to look for another solution. And so this biomass thermal solution is actually really growing ahead of steam, excuse the pun, in South Africa. So Fairfield's got another 6 sites. And once we've completed this site, we're actually going live producing steam this week at the first site, and then we'll be moving on to the other 6 sites that they're keen to have the solution installed. So revenue really comes from the steam supply agreement as well as from carbon credits. Our run rate exceeds 12% per project. The technology is bankable, so meaning it supports financing and it's genuinely scalable, which is why we're involved in it.
The main barrier to entry for rolling out synthetic fuels on a commercial scale has been cost, because at present the cost to produce them is generally far greater than fossil-based equivalents. In your view, how long will it take to overcome this cost differential, and how do we get there?
Yeah, another very good question, and I'll be straight with you, Jesse. I mean, today, green hydrogen costs what, roughly 3 to 6 times more per unit of energy than natural gas. But I would say that the path to cost parity runs through 3 clear channels. I'd say the first is electrolyzer manufacturing costs have followed a learning curve similar to solar. So if you recall how expensive solar used to be, it's still pretty expensive, but there's been about a 15 to 20% reduction per doubling of installed capacity. So really, the bigger the project, the more the price comes down accordingly. Secondly, renewable electricity costs, which is really the largest input for green hydrogen, they've dropped dramatically and they continue to fall. So, and then thirdly, I'd say carbon pricing, and again those regulatory mandates that I mentioned earlier, they're effectively raising the cost of fossil fuel alternatives, particularly in Europe. Obviously, not so much over in the US with the drill baby drill philosophy, but certainly in Europe, there's a lot of mandates. There's a lot of tariffs, etc. So on fossil fuels. So it's a heavily regulated market, and that shifts the comparison even without reducing green hydrogen's production cost. So my view is that in specific high value industrial applications where companies face these carbon penalties, they face ESG pressure, and they can structure long-term offtake agreements, commercial viability is actually achievable within 3 to 5 years, but again, at scale, right? So large industrial applications, for example. I'd say biomass thermal side is arguably already there in many markets. I think in many markets like South Africa, companies, industrial facilities, as I mentioned, can certainly see the benefits of it. But I said the question isn't really whether synthetic fuels become competitive. It's about sequencing the markets correctly, I think, if I can put it that way. Starting where the economics already work and then using those early projects to drive down the cost curve for the next wave.
Let's dive a little bit deeper into how fusion fuel fits into the picture. You already gave us an overview of the green hydrogen and biomass thermal power generation side of the business. Any other details you can share there, and also the other aspects of your business and the overall vision and game plan for the company moving forward?
Yeah, so we're a diversified integrated energy platform. We're obviously a company that's listed on NASDAQ. Our ticker is HTOO. We're an Irish company, so we're a foreign filer. We're headquartered in Dublin. Our model, I would say, is simple in concept, but hopefully powerful in execution. We own and grow a portfolio of high margin energy businesses spanning royalties, which are incoming. I'll explain why shortly, and then production and distribution across multiple geographies and fuel types. So there's three pillars of our business today, and there's a fourth that's incoming, which we've signed, and that's subject to shareholder approval. So I'll start with the incoming one first. It might be one that you're interested in on the commodity side. So that's Royal Uranium. We've signed to acquire 100% of Royal Uranium, or 75 to 100%, but it's looking like it's going to be 100%. And that transaction is subject to shareholder approval at our extraordinary general meeting, which is coming up in May. Anyway, so Royal Uranium has 19 strategic royalties across what I would say are premier uranium and gas jurisdictions in Canada, Colombia, and Argentina. I'll probably cover that more later if you have some questions in that line. But then, so that's one pillar that's incoming. Then we've got three other pillars, or subsidiaries, as we say, which exist today. One of which is Al Shola Gas. So that's a United Arab Emirates gas utility. It was founded in 1980. It's got over 38,000 recurring customers, and it's got a strong engineering project backlog. Then we've got Bright Hydrogen Solutions, as I've already mentioned. That's our green hydrogen EPC and infrastructure platform in Southern Europe, and it's backed by that 30 million euro investment vehicle. And then we've got BioSteam Energy, that 51% owned joint venture in South Africa on the biomass thermal power side. So I would say what ties the platform together, and this is you asked the question about vision. So, we're technology agnostic. I always use that term because we're not picking any one winner in the energy sector. We used to be a green hydrogen play, purely green hydrogen, and we had to pivot and grow the way we've grown and diversify the platform. If one subsidiary slows down, we don't fail as a business. At least we shouldn't, right? So we also don't. So we're asset light. We have the full value chain, and we also don't manufacture electrolyzers on the hydrogen side. We don't operate uranium mines. We don't plan to, at least. And we capture margin at the royalty, at the engineering, distribution, and at the maintenance layers. So it's risk-adjusted returns, which we believe are more attractive. And I'd also say, just with regard to the business, our independently verified sum of the parts valuation is much higher than our current market cap. I know every director or company manager would say that. Certainly, every CEO would say that. But we'll be presenting that independently verified sum of the parts valuation at our next investor update presentation as well, which might be helpful for the market to understand each of the businesses and what our real valuation should look like.
Great. I definitely want to dive into some more details on everything you just discussed, starting with the Al Shola gas project in Dubai. Could you walk us through operations there, the value proposition, and also, obviously, with the conflict in the Middle East discussed earlier, we've heard of attacks happening on the UAE. Is the company facing any challenges there as a result?
Yeah, so I'll tell you about the business first, and then happy to cover some of the challenges we're facing there. Certainly, our staff have been facing. Al Shola is one of Dubai's longest standing LPG contractors. So just to clarify what we do there, we design, engineer, build, install central gas systems. So in the United Arab Emirates, for those who don't know, you don't have a centralized piped system for LPG or LNG gas. You have each building is responsible for its own gas supply. So if you take an apartment block, for example, residential apartment block, you've got a large LPG gas tank on the roof of the building. Some buildings are much taller, so you have it at a certain number of floors in the large skyscrapers. But you've got an LPG tank or a number of LPG tanks. That's then piped into each individual apartment, and there's a gas meter, etc. So we design, engineer, build, install, and maintain those centralized gas systems that go into these residential and commercial facilities, restaurants, etc. as well. We then actually also supply the gas in bulk and in cylinder format. So the business actually started in the 80s as a cylinder distributor, right? Very simple business where it basically would take the gas cylinders, refill them, and sell them on to the customer. Nowadays, you order your gas cylinder. A restaurant, for example, will order its gas cylinders on an app. They get delivered in 15 to 30 minutes. Very efficient in Dubai and the whole of the UAE. And so that's the cylinder distribution side, but we also supply gas in bulk. So those big gas tanks that I was referring to, we have trucks on the road, big bobtail trucks that are obviously going around 14 to 16 hours a day filling up these gas tanks. We then actually bill the end customer for their gas usage. Anyway, I know it's a bit of a long story, but hopefully it just paints the picture of what that business does. It's the full utility solution that we actually provide to most customers. Business founded in 1980, ISO 9001 certified. As I mentioned, serving over 38,000 residential and commercial customers only in the United Arab Emirates. It is the anchor revenue driver of the group right now, approximately just over 16 million US last year. It's been growing nicely, 20 to 30% year on year, closer to 30%. So that's been good, very good, solid, reliable business in the group. And then I mentioned that recurring utility revenue from metered gas supply. That recurring revenue is really good high margin, sort of 40% margins for the business. In 2025, we had Fusion's first year of consolidation. We've seen about 45.9%, 46% revenue growth at Al Shola Gas. We signed nearly $10 million in new contracts during the year. We've got an 18-month backlog of projects, as I mentioned. And we've added just very recently in Q1 2026 over $1 million of new engineering subcontracts. So again, the value proposition, I'd say, is pretty straightforward. 45-year operating history in Dubai. It gives us a distribution network, customer relationships. We're expanding that business into Sharjah. So we're primarily in Dubai at the moment. A great market to be in because there's lots of construction going on, lots of expats moving there, etc. Lots of growth in the economy. But then we're also we're expanding into Sharjah, into Ras Al Khaimah, Fujairah, for those who know the Emirates, Ajman, Northern Emirates. So I think that's important. But anyway, you asked about the conflict. Very important question. We're definitely taking it seriously and monitoring it closely. But I'd say the UAE has consistently demonstrated that it's one of the most politically stable and economically resilient jurisdictions in the region, and possibly even in the world. I know some might not want to agree to that, but it's been very, very stable for a long time. Yes, it's been attacked. It's had a number of missiles fired at it. I'll be honest, our staff, when everything kicked off on the Saturday, I was on the phone straight away with Sanjeev. He was very, very stressed, very, very concerned. But our staff were in the office on Monday, and we've really continued business as usual. We've had staff on site, projects have been continuing, etc. Not saying there's not been challenges. I'll probably mention a few of those, but the important point is that the UAE's got very strong defense infrastructure, so similar to Israel, and it's also got those deep Western relationships. It's got a proven track record, I'd say, of business continuity through volatility. When there's been a lot of, call it, crap going on around it, it's stayed stable. So those attacks haven't materially disrupted our operations, and the domestic distribution nature of our business means we're considerably less exposed to the Hormuz disruption than, for example, an upstream oil producer would be, right? So we're remaining vigilant, but we're not seeing it as a material operational risk today. We have seen a rise in gas prices. Gas prices always been quite cheap. I can go into the numbers, but don't necessarily want to bore you. But the point is, we've also been able to raise some of those prices on to the customers. We've seen about a 9 to 10% drop at the moment in gas consumption. And fortunately, we don't service, for example, too many high-end hotels, which are probably unoccupied. I mean, from what I hear, mostly unoccupied at the moment. So our customer base is still there, still living there, still consuming gas, largely. So we've seen a little bit of a drop. But yeah, I mean, Jesse, hopefully that summarizes. I've mentioned a lot, but yeah, there's a lot going on. But yeah, it's a good question.
Yeah, great summary of the situation. I want to talk about the uranium side of the business now. You mentioned a royalty model there. I know that you've got royalty exposure to Jaguar Uranium. There's some recent news out about that. That's a project in Argentina. You also mentioned some other jurisdictions that you're having royalty exposure to. Maybe you could walk us through that side of the business.
Yeah, so let me summarize first sort of the 19 royalties and just that supply deficit and why uranium is so important. I suppose most of your listeners will already know, and they'll say stop preaching to the converted here, but I'll do it anyway for those that don't, and then I'll talk a bit about Jaguar. Um, so this raw uranium transaction is something we're genuinely excited about. As I mentioned, raw uranium holds 19 strategic royalties. 16 of those are uranium royalties. Three of them are natural gas. They're across premier jurisdictions, the Athabasca Basin, primarily, which is the highest grade uranium districts on the planet. Then, Colombia and Argentina, we've got the natural gas royalties, which are actually producing modest revenue, roughly 500,000 a year. They're in Alberta, Canada. But I think more importantly, the counterparties include your top tier operators, so the likes of Cameco, Orano, Uranium Energy Corp, ISO Energy. You know, some of these operators are multi-billion dollar market cap companies, right? So top tier operators for sure, the real who's who of the industry. And then that structural setup for uranium right now is exceptional, right? We mentioned the 1970s, but right now it's exceptional. Global production is around 173 million pounds, and the reactor demand is over 200 million, right? So there's a widening supply deficit. New mines take over 10 years to develop. So, it's pretty stressful right now if you think about it from a supply perspective against the demand. And that demand just keeps accelerating. Nuclear capacity is expected to grow 40% by 2040. I mentioned those 75 plus reactors under construction. AI data centers, everyone knows the story, but it's creating baseload power demand that really only nuclear can reliably serve or service at scale. And then uranium was also recently reinstated to the US critical minerals list, right? So Western utilities are urgently de-Russifying their supply chains. I don't even know if that's a word, but I think it should make sense. Yeah, so that's sort of the reasoning behind us moving into this area and why we're excited about why we think it's important for the growth of our business and that whole diversification story that I've mentioned. But with regards to Jaguar Uranium, NYC listed company, recently IPO'd on the New York Stock Exchange. But with Jaguar, we've got three royalties, and they range from 1 to 2% of net smelter return. So many may know what that means, but for those who don't, is that when these mines start producing, and as you've seen possibly in Jaguar's news of late, there's a lot of activity going on there. So things are certainly trending in the right direction. But we would get 1 to 2% of the revenue received from the sale of their extracted uranium or other metals. And that's calculated after deducting the costs of getting the raw ore into a saleable state. So that what does that mean? Smelting, refining, transportation charges, etc. So that's what the net smelter return ultimately means. But yeah, Jaguar itself, as I mentioned, lots of activity, but it's had a strong start to 2026 following its IPO in Feb. It secured a formal government collaboration agreement in Argentina's Mendoza province in March, if I recall, and received regulatory approval to begin fieldwork at the Laguna Salada project. The US-Argentina Critical Minerals Agreement, signed in February, is important because it further validates the strategic importance of Jaguar's South American assets. So it seems, from what we can see in the news, and actually the CEO of Jaguar sits on our board. So we're seeing that the company is moving from planning into active exploration. There's permitting underway at that historic Huemul mine, and lots of field work at Laguna Salada. So I see their progress as positive steps for us towards having mines that are producing, which we can obviously benefit from with our royalties. So that royalty model as such on the three Jaguar royalties is just a small part. We have 16 uranium royalties in total, and we're looking to grow that portfolio as well quite aggressively. That portfolio captures the upside with none of the operating risk. And I think that's quite important for your listeners to understand, or the royalty side, many may know, but we have no capital obligations on any of these assets. Every dollar of royalty revenue flows directly to profit, right? So the independent valuation, I think it's important to say, for Royal Uranium is well beyond what we're paying for it. And as the properties advance through development and into production, that value should grow. I must say, again, I've mentioned it already, but just to stress, the acquisition of Royal Uranium is pending shareholder approval. And that's looking like we believe we have enough shareholders to obtain that. And our EGM should take place in May 2026. Very, very slow process in Ireland to complete an acquisition. So we've been going through it. That's why it's been taking a bit of time. But the EGM notice will be out soon. And then once that's complete, we believe it could become a meaningful driver of our net asset value and our growth through 2027 and beyond. Sorry, a bit of a long answer there, Jesse, but hopefully that covers everything.
No, the more details, the better. What would you say are the main catalysts and news flow coming out of Fusion Fuel up ahead that investors can look forward to for the remainder of 2026 and perhaps even beyond?
Yeah, I'd say there's several near-term catalysts to watch. We're certainly working on a bunch of things. The most important, arguably, is the Royal Uranium shareholder vote that I mentioned during May 2026. Completion obviously formally brings that 19 royalty portfolio, which we're looking to grow, onto the balance sheet, and that sets up that net asset value re-rating, which we think is warranted. That's our opinion. Then you've got BioSteam's first commercial plant at Fairfield Dairy scheduled to go live this week. We've actually started producing steam on Sunday in the final tests. So that's that first site going live moment for us for the biomass platform. We start generating revenue, billing the customer for their steam energy consumption, and so forth. And then that successful launch opens the door to further projects, right, under our rights of first refusal ROFR that we have in that agreement. And then on Bright Hydrogen, that Spanish cement project is going into build out. We expect continued progress on that 57 megawatt pipeline. El Shola Gas is on a 20+% growth trajectory, as I mentioned, and that's expanding into new Emirates as our delivery capacity grows. And then I think it's important, at the parent level, we are loss making at the moment. That's important. We've been reducing those losses quite substantially. Our underlying operating businesses are profitable, yes, but with the substantial costs of being a public company, roughly 3.5 million a year, we've been loss making at the parent level. So 2027 is when we project the group to cross into what we would say is sustainable positive net income. And so the earnings inflection story, I would say, is not too far away. Some may say that's still quite far away, but if you look at where we've come from as a business, with massive losses pre-November 2024. Moving towards being a cash positive business, I think, is quite important. We've got good cash runway to get done what we need to get done, and I think that's also quite important for us.
Is there anything we haven't yet discussed or anything you think it's important to emphasize that potential shareholders of Fusion Fuel should be focused on?
Yeah, it's a good question. So I'm trying to think in terms of, I've covered a lot, but I would say that the technology agnostic platform that I mentioned earlier, that matters certainly to us, and I think to a lot of people more than many people realize. We're not a pure play hydrogen company betting on one technology. We're not a uranium miner exposed to a single asset. We have exposure to nuclear, gas, hydrogen, and biomass, and we're expanding the platform. We're across 4 continents, so we've got revenue at multiple points in the value chain. And in a world where energy policy is moving fast and no single technology, I believe, has a monopoly on the future, right? That diversification is really a structural advantage. It's not a compromise, in my opinion. It may make our story look a little bit more complex. I know much of the market likes a very, very simple story, and ours is fairly complex. I get that. I understand that. I grapple with that too all the time. But I do think it certainly works well when each of the pillars of our business are contributing to our growth. And if one slows down, as I mentioned earlier, it doesn't necessarily cause us to fail, right? So I think that's quite important. And then I would add that macro tail world is really as strong as it's ever been, as strong as it's been in decades. We're in really, the early innings, if I can use cricket terminology that maybe many won't know. We're in the early innings of a multi-decade energy investment cycle that mirrors the 1970s in its structural drivers. So the companies built to serve that last cycle became the energy giants of the 20th century. So we hope, and we're effectively a micro cap, we're a humble company, yes, but we're certainly working towards Fusion Fuel being part of that next generation of that fuel/energy story. I think that
Great.
should
Well,
hopefully cover some key points, yeah.
Yeah, fantastic. I'm going to put links in the description below to the Fusion Fuel website, as well as social media for people who want to follow along with the company. John Paul, this has been a great conversation, very enlightening. Thank you for coming on the show.
Thank you so much, Jesse. Really appreciate you having us. Thank you.
Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.